Today, we will discuss the tax implications of so-called adjusting journal entries in partnership agreements. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees, together with a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my law practice. Our firm website is www.cummings.law. As a threshold matter, I will use the terms partnership agreement, LLC agreement, and operating agreement interchangeably during this presentation. However, the object is the same. I am referring to that written agreement which governs the rights and obligations of partners in a partnership or members in a limited liability company where the entity is taxed as a partnership. If you have questions on this aspect particularly, I encourage you to review my earlier presentations on this topic, which delineate between legal entities, which are governed by state law, and their respective tax treatments as defined by the Federal Internal Revenue Code and Treasury regulations. In the realm of partnership agreements, the concept of adjusting journal entries often emerges as a pivotal element. These entries are essential for ensuring that financial statements and tax returns reflect the true financial position of a partnership and its partners. However, the tax implications of such entries are frequently misunderstood. Adjusting journal entries are modifications made to a partnership's financial records to account for accrued revenues, expenses, and other financial activities that have not yet been recorded. These adjustments are crucial for maintaining accurate and compliant financial statements and tax returns. Despite their importance, many partners and stakeholders underestimate the significant complexity involved in making these adjusting entries. A common misconception is that adjusting journal entries are merely administrative tasks or busy work with negligible tax consequences. This is far from the case. The intricacies of accounting and tax law mean that even seemingly simple adjustments can have significant and sometimes unexpected tax implications. Therefore, it is imperative to seek the guidance of an experienced attorney and CPA to navigate these complexities effectively. The tax implications of adjusting journal entries in partnership agreements are multifaceted. These entries can affect the taxable income of the partnership, which in turn influences the tax liabilities of the constituent partners. For instance, adjustments related to accrued expenses can reduce the partnership's taxable income, thereby potentially lowering the tax burden of the partners. Conversely, adjustments for accrued revenues can increase taxable income, resulting in potentially higher taxes. Moreover, the timing of these entries can also have significant tax consequences. Adjustments made at the end of a fiscal year can significantly impact the partnership's financial statements and tax returns. This is why it is crucial to ensure that all adjusting entries are accurately recorded and timed appropriately. Failure to do so can result in unwanted discrepancies that may trigger audits or penalties and interest from taxing authorities. One of the most prevalent misconceptions about adjusting journal entries is that they are optional or can be deferred indefinitely without consequence. In reality, these entries are a fundamental aspect of accrual accounting and are necessary for compliance with generally accepted accounting principles or US GAAP, as well as federal tax law. Ignoring or improperly handling or timing these entries can lead to inaccurate financial statements and the filing of false, incomplete, or misleading tax returns. Another common misconception is that adjusting journal entries have no impact on the constituent partners. That is totally false. Many partners believe that these entries only affect the partnership as a whole, which, if you know anything at all about partnership accounting or partnership law, you know that that is a complete fallacy. Since partnerships are pass-through entities, any changes in the partnership's taxable income will directly affect the tax liabilities of the constituent partners. This further underscores the importance of handling these adjusting journal entries appropriately and ensuring that they are addressed with precision and expertise consistently. Given the complexities and potential tax pitfalls of adjusting journal entries, the role of an experienced commercial law and tax attorney and CPA becomes indispensable. These professionals possess the expertise to ensure that all entries are made accurately and timed correctly in compliance with relevant accounting standards and tax law. They can provide valuable insights into the timing and nature of adjustments, helping to optimize the partnership's tax position. Furthermore, an attorney and CPA can assist in drafting partnership agreements that clearly outline the procedures for making these adjusting journal entries. This can prevent costly and time-consuming disputes amongst the partners and ensure that all parties are aware of their respective tax obligations. By leveraging the expertise of these trained professionals, partnerships can mitigate the significant risks associated with adjusting journal entries, both in substance and in timing, and ensure compliance with all legal and tax requirements. To optimize the tax implications of adjusting journal entries, partnerships should address a proactive and consistent approach. This should involve regular reviews of financial statements and ongoing communication with the attorney and CPA. By staying informed about changes in tax law, such as the recently enacted so-called One Big Beautiful Bill Act, which was signed into law on July 4th, 2025, partnerships can make timely adjustments that align with their financial and tax interests. Additionally, partnerships can benefit from implementing robust accounting systems and record-keeping requirements that facilitate accurate and efficient reporting of adjusting journal entries. These systems can streamline the process and reduce the risk of errors. And by combining technology with professional expertise, partnerships can enhance their financial reporting and minimize potential tax liabilities legally and ethically. In conclusion, adjusting journal entries in partnership agreements are far more than mere accounting formalities. They have significant tax implications that can affect both the partnership and the constituent partners. Misunderstanding or mishandling these entries can lead to very costly mistakes and potential legal issues. Therefore, it is essential for partnerships to engage the services of a competent and experienced attorney and CPA to navigate these complexities of adjusting journal entries and ensure harmonious and consistent compliance with all applicable law. By understanding the tax implications and adopting strategic approaches to managing these entries, partnerships can optimize their financial outcomes and maintain a strong compliance posture. This underscores the importance of professional guidance in the ever-evolving landscape of tax and accounting. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and is not legal advice, because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.